Whether you're swiping your card in Bangkok or booking a flight to Europe, there's a good chance Visa is involved. But what makes Visa such a strong business? And is its stock worth buying right now? In this video, I'll break down Visa as a company, dive into the financials, explore its risks and opportunities, and finally estimate its intrinsic value. Overview. Founded in 1958 and IPO in 2008. Operates in over 200 countries, makes money through fees. So service fees, data processing fees, international transaction fees, and other revenues like value-added services. Visa isn't a bank. It doesn't issue cards or lend money. Instead, Visa runs a global payment network that connects banks, merchants, and consumers. Every time you tap, swipe, or click pay, Visa takes a small cut. That cut depends on the country, but usually it's around 1.5 to 3.5%. So if you buy $100 of products, the merchant pays a couple dollars to Visa if you're using their card. Financials. Let's look how Visa is doing financially. Visa's forward earnings per share are $11.34, with the current price-to-earnings ratio of around 32. The company pays a modest dividend of $2.36 per year, which equates to a forward yield of just 0.6%. This low yield makes sense, as you will soon see the returns on money they are getting. Still, the dividend has been growing steadily, supported by a strong free cash flow. In terms of stock performance, Visa has delivered a total return of around 35% over the past year and an impressive 92% over the past 5 years. It has been a strong compounder, outpacing the market over the long term. Revenue per share has risen almost a decade straight, except a little hiccup in the COVID years. Total revenues have also been growing up steadily. EPS has had some ups and downs, but still going up steadily. One standout metric is Visa's return on invested capital, which sits at a remarkable 35%. This means Visa earns very high returns on the capital it reinvests. Another sign of its competitive moat and pricing power. In summary, Visa is a high-margin, capital-efficient business with an excellent long-term growth, a strong balance sheet, and rising cash flows. While it doesn't offer a big dividend, it more than makes up for it through capital appreciation and buybacks. And why would you offer a dividend when you can reinvest it with a high return? Future. Visa's future looks strong, but it's not without risks. Let's look at both sides of the coin, the opportunities and risks. Opportunities. Global shift to digital payments. Cash is still dominant in many emerging markets. As economies like India, Vietnam, and parts of Africa digitize, Visa stands to benefit. Growth in cross-border transactions. Travel and e-commerce are booming globally. Visa makes higher margins on international transactions. B2B payments and value-added services. Visa is pushing into business-to-business payments, fraud prevention, and data services. New revenue streams with higher margins. Risks. Regulation. Governments are watching. In the European Union, regulators have capped the interchange fees at 0.3% of the transaction value for credit cards, which significantly limits Visa's pricing power. And similar regulations could spread. High merchant fees in some countries. In places like Vietnam, if you pay with a credit card, some merchants add an extra 3 to 4% to your bill to cover the processing fees. That creates friction and discourages card usage, hurting Visa's growth potential. Technological disruption. New payment systems like real-time bank transfers, blockchain-based rails, or even central bank digital currencies could drastically reduce transaction costs, cutting out Visa altogether. Imagine a system where merchants only pay 0.1% or even less. In short, while Visa's network has a deep moat, the pressure is building, from regulators, merchants, and technology alike. If a low-cost alternative becomes mainstream, Visa's margins could come under serious threat. Intrinsic value. Let's try to estimate Visa's intrinsic value. Visa's current EPS is $11.34. Analysts are expecting Visa to grow earnings at around 13% per year. I will be a little more conservative and estimate 10% annually for the next 5 years, and I'll assume that it slows down to 8% per year for the next following 5 years. Historically, Visa's PE ratio has ranged between 25 and 40, with the median of around 33. Given Visa's high margins, global brand, and consistent cash generation, I believe a premium multiple is justified. But again, to stay conservative, I'll use a PE of 28 as a long-term average. And like always, I'm targeting at least 12% annual returns on my investments. Using these assumptions, I estimate Visa's intrinsic value to be around $340 per share. Here you can also see other prices and returns accordingly. Here's what that means. At the current price of around $370, the stock might be a little overvalued for a strict valuation perspective, if everything plays out according to these conservative assumptions. But as always, valuation is just one part of the picture. Visa's dominance in global payments, strong return on invested capital, and ongoing shift from cash to digital payments still offers strong long-term tailwinds. If growth comes in better than expected, or if the market assigns a higher PE due to its quality, upside remains. And in the meantime, Visa continues to return capital to its shareholders through dividends and massive share buybacks. As always, this is just one perspective. Do your own research and remember, this is not financial advice. Conclusion. Visa is a world-class business. It's highly profitable, asset-light, and earns a return on invested capital of around 35%. I like the company a lot, and I think it will remain strong for the foreseeable future. But despite that, I'm cautious. Visa and MasterCard essentially operate as a global duopoly, and that kind of dominance often invites regulation, competition, and innovation. We are already seeing fee caps in regions like Europe, and in countries like Vietnam, merchants pass the 4% card fees directly to the consumer. To me, that signs real friction in the current model, and friction creates opportunity for disruption. That's why I wouldn't be comfortable buying Visa at the current price. With my intrinsic value estimate around $340, I would want at least 20% discount from that before buying. I need that margin of safety because I believe this business, despite its strength, is likely to be disrupted in the future. And it could happen fast. Well, what do you think? Am I wrong on this one? Are you holding Visa or waiting for a better entry point like me? Let me know in the comments. Thanks for watching, and if you enjoyed this breakdown, hit the like and subscribe for more investing videos like this. And as always, do not lose money and safe travels. Bye bye.